The Financial Facts of Life, Part 1. Materials provided by Genesis Financial Management. The Financial Facts of Life. Live within your means. Budget your money. Anticipate your expenses. Save money each payday. Develop smart money habits. Understand how credit and debt work. Credit is the amount of money available to you through lenders, and debt is the amount of credit you're using at any given time. Buy smart. Stop overpaying. Determine what's a good value. Spot and avoid budget busters. Impulse buying, items with nothing to show afterwards. Get an education, job skills, and work experience. Become familiar with job benefits. Learn about financial services like checking and savings account, overdraft protection, balanced checkbooks. Learn how to borrow money. Learn about health insurance and medical plans at work. Learn how to shop for all types of insurance. Learn about contracts before you sign one. Learn about qualifying for a home. Learn about your taxes, how they affect you, how to legally reduce the amount you have to pay, how to increase your deductions, and how to fill out the forms. Some of these areas we will be covering throughout the courses. Money plays no favorites. So pay your bills on time, in full, with checks that do not bounce no matter what is happening in your life. No one will lend me money. Well, most people are turned down for credit because they have no credit experience or they have bad credit history. Both take time to fix. Bad luck can happen to anyone. Contact your creditors immediately and tell them what's going on if there's an issue. Evaluate your options. Take a second job, change spending habits, borrow money from a lender or from family, negotiate different terms with lenders, seek help from a credit counseling agency. Pay now or pay later. Just because you have access to credit does not mean you have to use it. Saving the money will always be cheaper than borrowing. Know what the terms of the loan will be and how much it will cost you to rent a lender's money. Fringe banking. Fringe banking is very expensive. The types of fringe banking include money orders, payday check cashing businesses, and pawn shops. Predatory lending practices. Predatory lenders charge exorbitant fees and interest rates and usually prey on people with bad credit. Predatory lenders often write contracts in such a way so as to confuse people. How have you been handling your money up to this point? Identify areas that you handle well. Identify areas that require immediate change. Identify areas that will need attention but that are not critical. You can accomplish your financial goals once you gain control of your finances. Living on the edge. You will face hard times sometimes in your life. You could lose your job, become ill, or your job may not pay enough to cover the basic living expenses. Saving for the proverbial rainy day is not just an old cliche. An emergency fund can help you through the tough times. Borrowing to cover everyday expenses just creates more expenses. Why have a budget? The reason you have a budget is so that you can get the things that you want. How much do you make? How much do you spend? How much money is left over? And what do you do with that money that's left over? Goals. Decide what your priorities are. Do I want to buy a car, boat, house? Do I want to travel? Do I want to eat out more often? Do I want to have children? Do I want to go to college? Do I want to retire early? Achieving your goals. You need a plan. You need a budget. How much income do you have coming in? What are your fixed expenses? What are your flexible expenses? How much are you saving? How much is left over? Budgeting is continuous and ongoing. Your budget is not set in stone, but changes with your needs. Budgeting gives you the power over your finances. It also gives you peace of mind. Make savings part of your budget. You should pay yourself first. You should save something every month, no matter how little. Saving is what helps you achieve your financial goals. You should have a minimum of 3 months savings for a cushion should you find yourself experiencing financial trouble. Plugging the spending leaks. Needs versus wants. Needs. They're your rent or house payment, your utilities, your car, your medical bills, your food, your insurance. Wants are your vacation, your boat, your manicures, your golf, your expensive sports car, and your cable TV. To borrow or not to borrow. Before you make any purchase, ask yourself how you will pay for it. Cash and wallet, savings, credit. There are two types of purchases, the big stuff and the everyday variety. The big stuff, that's a car, your home, your college. Most people have to take out a loan for these type of purchases. Everyday variety, your food, your clothes, your club memberships. Most people pay by cash or credit card. The question of cash or charge applies to almost every purchase you make. Using a credit card is taking out a loan. If you wouldn't go to a lender to borrow the money, don't put it on your charge card. Charging means you don't have to pay immediately, but you will have to pay more because of the interest. Charging can lead to impulse buying because it's easy. There's no immediate record of how much you've spent, and the payments are typically low. How can you use the credit card? Pay the balance in full every month, no interest charged. If you pay the minimum balance due each month, you will pay interest, and it could take years to pay off your balance. Pay more than the minimum balance. You will pay less in interest and pay off your balance sooner. How much debt can you afford? Rule of thumb, less than 20% of your income should be installment debt, credit cards, bank loans, and student loans. This number could be less if you have ongoing medical expenses or childcare, etc. The warning signs. Taking cash advances for everyday expenses or to pay other credit cards. Spending more than 20% of your income on debt. Charging purchases you used to pay in cash. Getting calls from your creditors. Making only minimum payments. Increasing overall debt each month. Owing more this year than last. Using more than 3 credit cards. Paying bills late. Things to think about. Before purchasing an item, determine if you really need it. Determine how much you are going to pay for it. Understand the financing method you choose and how much it'll cost you. Decide if it's a good deal. There are all sorts of lenders eager to lend to credit-worthy borrowers. Banks, credit unions, car dealers, finance companies, credit issuers. What questions might a lender ask if you want to borrow money? How will the money be used? How much will you need? How long before you repay the money? Will you pay it all back at once or in monthly payments? How much interest are you willing to pay? Do you understand how the loan contract will be enforced if you do not make repayment as agreed? Will you provide collateral? Will you need to sign a contract, or is a handshake good enough? Do you need to put any money down, or do you wish to borrow the full amount you need? What is your history for repaying loans? How much money do you make? How many other debts do you already have? How much longer will it be until each of your loans is paid off? Where do you bank? How much do you have in savings and checking? What loan officers are looking for? 1 to 2 years at the same address. No history of overdraft, stable job, sufficient income, collateral to secure the loan. Guard your personal information. You are providing sensitive personal data that could be used to steal your money. Be careful who you're sharing this information with. The loan application. The application is the first step in the process. Fill out completely and honestly. Don't guess or estimate. Provide accurate account numbers and balances. You should be able to provide 30 days worth of pay stubs. Loan terms. Different loan applicants may be granted loans and may be offered all different terms. Terms are based on the assessment of an applicant's likelihood to repay. The lower the risk, the lower the interest rate, and the better the terms. The higher the risk of default, the higher the interest rate, and the less attractive the terms. Why some loan applicants get turned down. There are many reasons why applications could be turned down. Credit score is not high enough, too many open accounts, even if the balances are zero. You owe too much money on monthly debts for lender guidelines. Monthly payments on debts too high for lender guidelines, and single large monthly payment too high for lender guidelines. You've not been on the job long enough. You've not had a stable source of income. Past credit problems. Borrowing more money than allowed under lender guidelines. Credit score. A low score can also affect your ability to get a job, whether or not a landlord will rent to you. You get hired by a prospective employer, cell phone deposits, and utility deposits. Your score contains your payment history, current amount of debt, length of credit history, new accounts, and types of credit. There are 3 national credit bureaus, your TransUnion, Equifax, and Experian. The most common credit score is your FICO. Too many inquiries. Every time someone other than yourself checks your credit, it will show as an inquiry on your report. If you have too many inquiries within a 6-month period, it might be a red flag to a lender of a potential spending problem. When you are spending for a car or big ticket item, do not let anyone pull your credit report until you're ready to actually purchase it from the lender. How to get that first loan. The first loan is the hardest to get when you have no track record, but it's not nearly as hard as it used to be to get credit. If you can show that you are a good credit risk, even for a small amount of money, the lender will probably take a chance. How to get the lender to say yes. You need to show that you're ready, willing, and able to repay the money. If a lender says no, ask what the problem is. Correct the problem. If it's misinformation, fix it. If it's too much money, ask for a smaller amount. Offset the risk. Offer a larger down payment. Offer collateral. Don't get mad or upset. Try to work with the lender instead. When the final answer is no, don't let it get you down. Try another lender. If no one will lend you the money, get a copy of your credit report. Make sure that all the information is correct on the credit report, correct any misinformation, and pay off the old debts and establish a good payment history. It's a good idea to pull your report 3 to 6 months before you try to get a loan. The role collateral plays in loan decisions. There are two basic types of loans. Secured loans. Property, an object of value, or money is put up as collateral for the loan. If you default on these payments, the lender can take your collateral and sell it to recover some or all of the money you owe. Unsecured loans. There is no collateral, just your word that you will repay the money you owe. Borrowers can get better terms for secured loans than unsecured loans. However, putting up collateral is not a guarantee of loan approval. Cash as collateral is the most desired by a lender. Why apply for a loan when you already have cash? You may want to establish or repair credit history. Your savings may be drawing more interest than you pay on the loan. Co-signers and co-applicants. If you cannot qualify for a loan by yourself, a co-signer with good credit may be able to help. The co-signer will be legally responsible for the debt if you don't make payments, but does not benefit from the loan. A co-applicant is someone who is legally responsible for the loan and will benefit from the loan. It is a bad idea for you to co-sign on a loan. An unromantic walk down the aisle. Someone with no credit history can gain access to credit if they marry someone with solid credit. Unfortunately, you can also gain your partner's bad credit rating. How to build a solid credit history. The number one way is to pay your bills in full on time. Repairing a bad credit score. Enroll in a secured credit card program. Take out small secured loan to repay the loan in a timely fashion. Stay on your job and in your home for a period of time. Pay down existing debts, even those that have been written off. Establish a savings account and borrow against it. If you have bad credit for whatever reason, no one can eliminate your past history. Establishing a credit history for the first time. Start locally with a banking relationship. You're like a checking account or a savings account. Show job stability and apply for a small loan. Discrimination. Creditworthiness has nothing to do with race, gender, religious beliefs, or physical abilities. Credit scoring methods were introduced to eliminate discrimination and are based on your history of repayment. If you experience discrimination, you should report it immediately. Beware of predatory lending. Take time to read and understand the terms of the deal. If you don't, you could pay unnecessary fees and interest rates. Some businesses can offer short-term loans that have up to 871% interest, such as payday lenders, title loan companies, check cashing establishments. What to look for? A lender asks you to sign papers with blanks. A lender makes you sign without reading them. Loan costs, good faith estimate, or truth in lending statements are not disclosed. Life insurance is added without your approval. There are steep prepayment penalties. The lender steers you into a high-interest loan when you know that you can qualify for better terms. Says no fees or closing costs. This usually means they're financed into the loan. Would you lend money to yourself knowing what you know now? Under what terms? Under what conditions? There are steps you can take to ensure that when you need to borrow money, your loan application will be approved. A lender is not doing you any favors by granting you a loan that you can't afford to repay. Know how to build a solid credit history. Beware of predatory lenders. The terms of a deal. Should you trust someone else or educate yourself? Trust is an important concept when it comes to your money. However, it is not vital. It's essential that you understand the terms and the conditions of the deal. Trust means different things to different people. The borrower wants to trust the lender to look out for his or her best interests. The lender trusts their loan officer to look out for their lender's best interests. The loan officer believes they can be trusted to do a competent job of putting together a deal and disclosing all the terms and conditions. Don't allow yourself to play the victim. You are not too old to learn. You are smart enough to understand. You can find the time and check it out. You should not depend on someone else to do it for you. Don't fall into the yes syndrome. If you don't understand a term or a concept, ask the person to explain it again. Don't be embarrassed. All lenders should be able to explain the terms and conditions in a manner that you can understand. 4-step process to any financial deal. Step 1. Decide what you want or need to purchase. Step 2. Find what you want a price you think is fair and that you're willing to pay. Step 3. Decide if you're going to pay a cash or a finance charge on your purchase. Step 4. If you finance, decide on what terms you'll accept. The biggest mistake made in purchasing a finance. Failing to take into account the true cost of purchasing by not asking what the interest rate is, not asking how long you'll pay, not asking what happens if you fall behind on those payments, only wanting to know what your monthly payment will be. 4 common criteria for every loan. Loan fees. Lenders must disclose what fees they charge for your loan. You should ask for these at the very beginning of the process. Interest rates. How much will it cost you to use a lender's money? Is it competitive with other lenders, considering your financial history, work background, etc.? Length of the loan. How long will it take you to repay this loan? The longer the loan, the lower the payments. The longer the loan, the more you'll pay in interest. All the other fine print. This is the part that often causes the borrower the most problems. Confusing language and terms, what happens when the payments are late, additional charges or fees, how to dispute charges, etc. Administration fees, processing fees, credit reports, origination fees, discount points, title insurance, commitment fees, underwriting fees, credit life insurance, disability insurance. Sometimes your lenders offer to add these fees into your loan or finance them in. Not only will you pay the fees, but you will also pay interest on them for the life of the loan. Fees can add significantly to the cost of your loan. Shop for the best terms. Interest rates. The lowest interest rate does not always mean the best loan. The Federal Truth in Lending Law requires lenders to present all of the terms of the loan in a uniform manner. Lenders must quote you the annual percentage rate or APR. The annual percentage rate is the total cost of your loan as a yearly rate. It includes the interest you'll pay on the loan plus any upfront fees that the lender charges. It'll be higher than the actual interest rate if there are upfront fees. 2 types of interest rate. Fixed interest, which means the interest rate stays the same for the life of the loan, and variable rates. The interest rate can change periodically. The frequency depends on what the loan document says, and the rates are based on different published standards. Length of the loan. How long will you take to repay it? Mortgages typically run 15, 20, or 30 years. Car loans can run as long as 7 years. Personal loans can be from 1 to 5 years. And credit card balances can take up to 30 years to repay if you only make the minimum payments. 2 basic types of loans. Installment loans. Loans set for a period of time, not automatically renewable. The longer the term for payoff, the smaller the monthly payment, and the longer the term for payoff, the higher the amount of interest you'll pay. Revolving loans. There's no time frame imposed for the repayment, can reuse credit without reapplying if you still have credit available, and you will pay much more in interest, and it will take years to pay off a balance if you only make the minimum payments. Secured versus unsecured. Secured loans. Lenders prefer secured loans. The borrower pledges certain properties to secure the loan. Bonds, CDs, house, car, furniture. Unsecured loans. Loans are not secured by property. They're signature loans or lines of credit, overdraft protection, credit cards. Usually higher interest rates, higher risk to the lender. The devil is in the details. You have to understand the details, and there can be a lot of them. They are usually in very fine print. Ask the lender for a copy of the documents and take them home to read. Ask someone if you don't understand them. there are two main forms, the promissory note and the security agreement. The promissory note is a document in which you agree to pay back the money. It spells out the terms you have agreed to, interest rate, amount you're borrowing, time period of the loan, monthly payment, and what other fees may be charged. Whereas a security agreement is a document in which you pledge collateral for a loan. It states under what terms a lender can take your collateral if you don't make payments. It states penalties for paying late. It states who pays legal and collection costs, and states if the lender can take money out of your other accounts and apply it to your loan. 12 terms you need to know before you decide on a credit card. The annual fee, the annual percentage rate, fixed rate or variable, and terms for the adjustment, the grace period, if any, minimum finance charge, method of computing finance, amount of credit limit, the penalty for late payments, fee for cash advances, the penalty for exceeding your credit limit, length of the introductory rate, interest rate you will be charged if the account is not in good standing. Shop for the right deal. Visit more than one lender before you make a decision. Ask if there are any special financing programs. Don't be afraid to negotiate, but don't be offended if the lender won't. What are you agreeing to? Pledging your property for security on a loan. Agreeing to keep secured property insured. Paying any taxes when due. Keeping the property in good repair. Agreeing not to sell secured property without any permission. Paying an attorney's fees or costs for collections. You are in default if you make a payment a day, week, or a month late. You make only a partial payment. You make misstatements on your loan application. You fail to disclose material facts about your finances. You don't make a payment on another loan with that lender. You file for bankruptcy against the grantor of the loan. You don't keep insurance or pay taxes on the security for the loan. The lender believes in good faith you may not be able or willing to pay as promised. What can the lender do about the default? They can require immediate payment of unpaid balance, including interest. They can repossess and sell the property pledged as security. If they do not get enough to cover the amount that you owe, you are still responsible for the difference. They do not have to accept any payments unless required by law. What's a good deal and what's not? This depends on what you're willing to pay. It also depends on what financing terms you're willing to accept. The biggest mistake people make is to rush into a deal despite price and terms. The better your credit, the better the terms, and the less you'll have to pay. Summary of Part 1. In this session, we learned about budgets, the importance of paying debts on time, what lenders look for in order to qualify you for a loan or a line of credit, the benefits of using cash versus credit cards, lending terminology, different types of debts and loans, interest rates, and the difference between secured versus unsecured. There will be 2 more parts to this educational program, so stay tuned. Questions, comments, experiences? To speak with one of our certified personal financial counselors, you can call us at 877-202-9246 or visit us at www.yourgfm.org.